Hi there, Kristin Cooper, your certified mortgage planning specialist and mortgage advisor. So excited that you're here today. Really education is at the heart of what I love providing because that allows us to make smart decisions. So today we're going to be talking about different options if you already own a home and want to purchase another home, what that can look like. I know it can be really overwhelming and a lot of fear can come with it, just not knowing how it all play out and what it would look like. But it is one of those things that most people that own a home will go through. So I want to provide some education and some process timelines and things that will make it really a little bit less scary for you to be able to decide what you want to do moving forward. But just know you can always reach out if you have any questions. I'm happy to jump on a strategy call with you and discuss things specific to you so that we can make sure that you have the right information. So let's dive in and talk about some different options today. So what we're going to be looking at is really just getting yourself ready and planning to be in a position that if you decide to purchase another home in the future, that you'll be able to do that. So, if you're not sure that you want to sell your home and buy another home, or not sure if you want to rent out your home and buy another home, there's lots of different scenarios that we need to go through to see what really is going to be beneficial for you. And so that's really what we're going to be looking at today. So buying another home, what are my options? And am I going to be buying a home first? Is that other home that I'm going to buy, is it going to be a primary home that I'm going to now live in that one as my primary residence? Is it going to be a second home where maybe I'm going to vacation from that home? Or are we going to buy another home as a rental property? I'm going to start looking into building income for maybe retirement strategies or tax strategies. So really identifying that. And then what are those options? Are we going to sell and buy? Are we going to buy a home now, sell later? Are we going to buy a new primary home, rent out the current home? Are we going to pay off debt through the purchase? Are we going to need upgrades? So all of these are very valid questions that we need to ask when we're going through mortgage planning and mortgage strategies for real estate. We're going to talk about minimum down payment requirements, what net proceeds are and selling costs if you decide to sell your home, capital gains, rental property investing, estate planning, which is really going to be important if you don't have an estate plan set up. And then talk about, what's next, what's next from here, and then ask some questions. If you have them, please put them in the chat and we'll try to address those questions or get them back out to you. So first, for what is the difference between a primary home, a second home, and a rental home? Well, a primary home is a home that you intend to live in. And so it does allow for better financing. It has lower down payment options depending on the program and whether it's a government insured loan like FHA that requires only 3.5% down, or a conventional loan that would require 5% down if you already own a home. A lot of people think that you would have to put 20% down. And as you can see here, that's not the case. Even with VA, we have what's called second tier entitlement, meaning if you already have a VA loan and you're looking to use your VA loan again, that might be an option without even having to sell your current home. So we'd want to look at that. And then we do have down payment options. If you're going to buy a home again, it's not just for first time buyers. So a lot of people don't realize that maybe you can keep your current terms on your home as a rental and buy another property with no money down. So we could look at those options. Primary home is better terms, so it's lower interest rates than what you would get on a second home or a rental property. A second home or a vacation home requires at least 10% down. It does have higher rates because it's not your primary residence, which means it's a higher risk for the lender that if you were to choose between your primary or the vacation home, you would let the vacation home go before the primary. And then your intention is to occupy it. So you need to occupy it for some time of the year. And so it can't be a rental property, which is where you would have a tenant actually living in the property. A rental property requires more down, so at least 15% down. The more you put down, the better the rates are going to be, but it does have an option for less down. And again, it is higher rates because it's income producing, and again, higher risk because you'd let that property go before a primary. And you may, depending on if you purchase or keep a property, you may be able to use rental income on that property to help you qualify. So a lot of people think that, I can't buy a rental property because I can't afford both homes. There may be an opportunity for you to purchase and use rental income to offset that mortgage, which we would just need to look at. Typically, when you have a rental property, we do want to make sure that you can afford the property. So reserves means that after your down payment and closing costs, that you still have some funds and assets that you can pull from if you're in a tough spot. So when you do get a rental property, sometimes we do require that you have additional what's called reserves, money left over. So what are my options? If I am looking to buy another home, what can I do? What are the options that I have? Do I sell my current home and then buy now, which is called a contingent offer, meaning that we're going to work concurrently to close the sale of your home within purchasing the home? that you're looking to purchase. And that way you can use the equity from the sale of your home towards the new purchase. And you only have to qualify for the new home purchase. You don't have to qualify for the mortgage that you have right now because that's going to be paid off. So this is what is a lot of people go this direction because they can't maybe afford both homes. And so they have to sell one to buy the other, or maybe they don't have enough for a down payment for a new purchase. So they need the equity from their home in order to purchase a new home. So depending on, your situation, it will just, decide which options are available to you. But that's the benefit, is that you would be able to use the equity from this home, put it into a new home, and only have the one mortgage payment. We work really closely as a team with the real estate agent and myself to make sure that, there's a lot of fear. You don't want to be homeless. And of course, we take that very seriously. And we want to make sure that when we're structuring your contract, when we're structuring your financing, when we're structuring your closing dates, that we ensure that you're going to be able to move seamlessly from one property to another, and that you understand if there's any, concerns that may not be the case. So we make sure that maybe there's a rent back option, meaning that you get to stay in your home, you sell it, you close it, you get the funds, from the sale of your home, but that new owner that purchased your home is allowing you to stay in the home and rent it back for 30 or 60 days. And so that would allow you time to be able to stay in the property and move into the new property. So all of these contract structuring are things that we do as a team to make sure that you're in a good position. And that's why you work with a team that is, experts that have been in the field a long time and understand how to do this, so that you don't end up, homeless, that you don't end up, spending a lot of money or losing money and things like that. First mortgage payment on a new mortgage, which a lot of people are concerned, I can't afford to have two mortgage payments for long term. So let's just say that you closed in May. Well, if you close in May, typically your first payment on your new mortgage isn't due until July. So it has a delay start before the mortgage with the way the interest is collected, which is super helpful when you're selling one home and buying another home. So there is going to be some wiggle room in there. So you don't have to pay typically two payments on a mortgage. There is going to be some time that you have some wiggle room to be able to not have those payments. So typically what happens is we will transfer funds from the sale of your home. So we'll work with the escrow company who is going to be working on the sale of your home, so that when your home closes, we can just have them wire the funds to the new escrow company directly. So you don't have to worry about all of that of getting the funds and dealing with the transfers and all that. We work really closely with you again to make it as seamless as possible. Now, if you don't want to use all the funds from the sale of your home, that's fine. We can have just whatever portion we're going to use for the new purchase sent over, and then you would get the rest of the funds. So it's not all tied up, but we make sure that we work closely with you to ensure that happens. So that's the first option. You sell your home and you buy now. Benefit, you get to use the equity from your home and put it right into the new home and or pay off debt and the new home, which we'll talk about. And you only have to qualify for one mortgage. But if you know this market, or you don't want to have to sell your home before buying another home, another option is that you buy now and sell later. So in this scenario, a couple of things that we got to, make sure to address is, where are the funds going to come from the new purchase? So again, if it's a primary residence that you're purchasing, it's less down, but you still have to have those funds available, and they need to be in verifiable funds. So whether it's your assets, which is like your checking, your saving, your stocks, your bonds, your retirement account, all of those funds can be used, including gift funds, or maybe you have an equity line of credit on your primary where we could take funds from that and you can qualify with that payment. We may be able to use those funds so that you can use that towards a down payment. I have a lot of clients that will take a temporary retirement loan to purchase a new home. And then when their home sells, they'll pay off that retirement loan so that they're not having any consequence or tax issues or anything like that, but able to get into the new home. So that's one option. You do have to qualify with both mortgages if your intention is buy the new home and sell the other. So we need to make sure that you can qualify with both, unless you plan to rent out the home that you're moving out of. So there are some options that we can look at, and this is where it comes into mortgage planning and mortgage structuring, and we'll work one-on-one on this to figure out what's best for you. But if your intention is to sell later, what do you plan on doing with those funds? Well, if you took the full amount from your retirement that you plan to get from the sale, then you may just use those funds to repay the retirement and we're good. But if you're going to have additional funds from the sale of your home and you're like, hey, I really want to put these funds towards the purchase, once it sells, so that I can lower my mortgage payment, then we'll look at one of two things depending on the program. We'll either look at what's called a first and a second, which means that we'll make the first whatever the long-term loan is going to be, and that second will be the amount that you plan to pay off once your home sells. Or we will look at what's called a recast depending on the program, which means that after you close, that you can put a lump sum payment towards your loan and then have it re-amortized so that it reduces your payment. So the benefit of this is that you're not a contingent offer, which depending on the market that you're in, so if you're in a seller's market where there's a lot of buyers looking for homes, which is where we happen to be right now, then this would be a great option to help get your offer accepted. Sellers and listing agents don't want to take an offer that's contingent just in case something falls apart. And so they want to make sure that they take the strongest offer. So if you're able to not go contingent, meaning that you're able to buy without having to sell, then that makes your offer stronger. So the benefit is it's going to make your offer stronger. You won't have timeframes that you're, concerned about having to meet in order to make sure you're not, without a home. And those are, and that you're rushed to have to move from one property to the next. So that's a really great option if you can qualify for both payments. Now, we talked about selling your home and using those funds towards the new purchase. What does that mean? So when you sell a home, it's called net proceeds, which means you take whatever your sales price is minus all the cost for selling, minus any payoffs that you have attached to the property, which may be mortgage, or if you're paying off a solar or HVAC or any of those, you minus all that out, then you have what's called your net closing costs. So you have your sales price minus any payoffs, minus closing costs, and then your net close. So a lot of people don't realize that when you sell a home, that there's cost associated with this. So you may think, oh, I have $200,000 in equity I can use towards my purchase. May not be the case, typically is not, because you have all the costs that go with selling the home. So you'll want to work with the real estate agent and figure out what those costs are going to be, because you have your standard seller's costs, but you also have to pay commissions for the agent that's going to be selling your home, as well as the agent that brings a buyer to purchase your home. So that's part of our mortgage planning and mortgage strategy, is we're looking at how much money are you going to be getting from the sale of your home that you can use towards the new purchase. You do want to look into capital gains. Capital gains, you'll want to talk with your CPA, and you can look at the information from the IRS to figure out what would be applicable for you. It's the IRS publication 523. And so what capital gains is if you sell property or you sell an investment, and a property is an investment, and you make a gain, then you have to pay taxes on that gain. The good news is for most people that it's not going to be your normal tax rate that you would pay with the IRS. It's going to be what's called a capital gains tax, which ranges 0 to 20% depending on your income. However, there is what's called a primary residence exclusion. That primary residence exclusion says that if you live there for 2 of the last 5 years, you might be able to sell your house without capital gains. So you want to work with your CPA to make sure, but typically if you've lived in the home for at least 2 years, so you got to make sure you don't move before the 2 years, it's been your primary residence, then $250,000 of the gain for each taxpayer will be able to use that. So let's say that you, bought your house, you sold it, and you end up netting $250,000. Well, you will probably qualify for this capital gains exclusion if you've never sold a home in the last 2 years. It's your primary, and that you meet the qualifications. If you are a joint couple, then it can be up to $500,000 for married couples. So you want to look into that and make sure with your CPA before you sell that that's applicable to you. Typically it is. But you also want to make sure that you've been in the property for 2 years so you don't get hit with capital gains. Now, this is just a primary residence. So what if it's a rental property? Well, rental properties then have to pay capital gains, and you'll want to talk with your CPA to find out what the capital gains are, but that's only at the time of sale, and that's after your closing costs. So you would take your original purchase price minus any upgrades you've done to your home. So you want to make sure you keep receipts, always keep those documented, minus any costs. And then you have your tax basis. So you want to look into capital gains if you haven't owned your home for at least 2 years, or if it's a rental property or has been rented, and make sure that you qualify for the primary residence exclusion. So now we look at buying a new primary and renting out the current home. So let's say that you don't want to pay capital gains. So let's say it's a property you have capital gains, and you're like, oh, we don't want to sell the home and pay capital gains. Well, you can rent it out. You don't have to pay capital gains right now. You could just keep renting it and take the benefit of that. Or you just say, we want to start becoming landlords. We want to start building income. We want to start building our wealth. We want to start building our portfolio. Well, you could buy a new primary home and you could rent out the current home. So we can look at those options too. We may be able to use rental income from the departing home. So the home you currently live in. If you have a lease agreement, then you may be able to use some of the rents that you're getting from that lease agreement towards your qualifying to be able to purchase a new home. So we can look at those options, but it's a way for you to build wealth through real estate. You really want to diversify when you're building wealth. and cash flow. And this is a great opportunity if you're able to build wealth through the real estate. Now, you do have to have a down payment for the new home purchase. If you're going to keep your home as it is, you can either refinance the current home and pull cash out. You can, if you have other funds that are in your assets already, or retirement that you take funds from as a loan and buy a new primary, those are all options. But you do have to have a down payment unless you qualify for, maybe a VA loan or something like that, or USDA that's zero down. You would have to have a down payment for the new purchase. It creates cash flow from the rental property. If you keep the rental property, if you're able to rent it out and your payment's going to be lower than what you can rent it out for, that's now cash flow that you can use towards maybe purchasing the new home. And it does give you tax write-off. So if you're someone that's looking for additional tax write-offs, this would be falling under what's called a Schedule E, which means it's, long-term amortization that you get to depreciate within the Schedule E, which is a write-off. You get to write off, the mortgage interest, the taxes, any costs, any property management, and then that's your net income. So it's a really great way for you to have additional income and be able to write off additional expenses. And then you can, again, avoid capital gains maybe on a sell today. So all great reasons that you would want to maybe keep your primary home and rent out the other home. You would need a down payment, and you would need to qualify for both homes. Unless we can use rental income to qualify, then we may be able to offset some of that. So great option to look into. And then some other strategic things that, some people don't think of. You're in a home right now and you're like, gosh, we really need a bigger home. We've expanded our family, but we just can't afford it. Well, what I found a lot with my clients is, they may have $200,000 in their home that they can use towards a new purchase, and they have $50,000 in debt that maybe is $1,500 in monthly mortgage payments, or probably $2,000. Well, what if we took $50,000 from the sale of your home, paid off all your debt, and then use the additional $150,000 towards the purchase? Your mortgage would be a little bit higher, putting a little bit less down, but your overall finance cash flow and expenses would be less. So this is a great way that I work with my clients that already own a home to help you maximize your affordability so that you can get the home that you desire. And then from there, we really, work on a game plan of setting up a proper budget to make sure you're not in a position that you start charging up those debts again, because then you're in a worse position. But if you utilize it as a financial tool and be very strategic, then you're able to put yourself in a better position. So you may not even realize that you could probably lower your outgoing expenses in the same. So let's say that you want to, you're moving out of area, you want to buy another home. Oftentimes I have clients that use their funds and pay off all debt and buy a new home, and their outgoing expenses are less than what it currently is. So there are some great options that we're able to use for that to make sure that you're, utilizing your funds the best way. And again, as a mortgage advisor and a mortgage strategist, that's my goal. It's not just here's a 30-year fixed, putting all the money that you have down. No, what's going to work for you? And then we talk about home upgrade purchase options. So this is really great to keep in mind when you're out shopping for a home and you're looking at them, and depending on the market, and you're like, gosh, the homes that I love are like $750,000, but I can only afford $650,000. Well, what about, looking at homes that are $650,000 or $600,000, maybe go a little bit less, that need work, and holding some of the funds that you have from the sale of your home or additional funds that you may have out there, depending on how you structure it, and use those funds for the upgrade. So put less down so that you have funds to be able to upgrade the home, but you're buying at a lower purchase price, so the affordability is there. So keeping some money back that you have, whether it's from the sale of your home or from money that you have set aside for the down payment and closing costs to be able to use to upgrade a home, is a really great option to put yourself in a better affordable option and still get, the home that you desire. So, really what you want to look at if you're keeping a rental property and going this option is you want to look at, what's my estimated rate of return? The reason that you want to look into becoming an investor is that you're starting to build wealth, whether that's through cash flow. Maybe initially when you buy it, it doesn't cash flow, but over time it's going to. So you have a cycle of real estate. And what I mean by that is you may have a higher payment initially, and then maybe interest rates drop, and now you're able to refinance, pay off the current loan, get a new loan at a lower payment. Now it's cash flowing. But also with rental properties, you have a rate of increase that you can increase the rent every year, and rent's always gone up. So as you see, you start at one level and you continue to go up. I know on our rental property that we have in Idaho, we started with a rent of $1,800 and we're now at $2,400. So that's what's really nice about it, is as the rents go up, my mortgage payment's still fixed, it's still low. So that's all additional cash flow that I'm earning over time. So you got to keep the big picture in mind too, is you need to look at all the numbers now it may just even out to where you're not cash flowing initially, but in the future with where rents are going, then they will cash flow. Plus take into consideration, when you have that, not only are you paying down the loan, which is now your equity that you have. So that's now in your wealth, that's now in your financial portfolio is your equity, which is your money. And then you also have appreciation. So how much the home values go up is now your equity as well, which is your appreciation. So being very aware when you're going to keep it as a rental property is important of, okay, here's what our expenses is going to be. Are we going to hire a property manager? If so, what's that going to be? That cost, because that's going to be an expense. You really want to have 6 months of the rental property in a separate savings account as a cushion, just in case. You never know what's going to happen. And as you start to build, if you do have cash flow in the property, maybe building that up to where you have a $5,000 cushion plus 6 months of the mortgage payment in a savings, so that you're in a good position to make sure that if any repairs come up, because they do, that you have the funds to be able to repair what needs to happen, as well as if it's vacant, for a couple of months. If somebody's not living there, you want to make sure that you can afford the payment too. So all of those are factors in, moving it into a rental property. So you want to look at, what's going to be the sales price, the cost of the sale, and the net proceeds from the sale, and then rate of return. So other things to kind of consider when it comes to rental properties and rental income. So if you're converting the primary home into a rental property, meaning that you live in the property right now and you're converting it into a primary home, again, you may be able to use rental income if we have a signed lease agreement to be able to offset the mortgage payment to help you be able to qualify for another property. So you can see annual lease, you could potentially use up to 75% of whatever that lease agreement is. FHA, if you have an FHA loan right now and you don't plan to refinance into a non-FHA loan and you're buying another property and you want to keep this one as a rental, you just can't have another FHA loan. So we need to make sure that that you're not getting another FHA loan on the primary residence. You do have to have reserves depending on the program, which again is saying how many months you need or how much money you need left as a cushion, and checking, savings, potentially retirement account, to be able to have as a safety cushion if something were to come up. But like I said, really as a rental property, you want to have 6 months anyhow of that mortgage payment in a separate savings account to ensure that you're in a good position. Another thing I always want to touch on, if you already own a home and don't have an estate plan set up, you definitely need to get an estate plan set up. An estate plan is done through an estate attorney. I don't do them, but it's the only way that you can protect your property against what's called probate. So if you're on title and something happens to you and it's just you on title, your property now goes to the court system, which is known as the probate process, in order to determine where your property goes. Now, keep in mind, it goes through a waterfall. So it would go to family if you have kids, and then it kind of goes out. So it's not just going to go to a random person, but the concern is it could take over a year before they even disposition where your property is to go to. And they can take a huge amount in fees for that year process that need to be paid because it had to go through the court system. So the only way to avoid that when you own a home is to set up an estate plan and put your property in a trust. So if you own a home right now and don't have an estate plan, I highly encourage that you reach out to an estate attorney. I'm happy to give you reference to great ones in the area and that you get that set up. But for sure, if you're buying another property, you definitely need to make sure that you are now protecting your assets. What's the point of building wealth if you're not going to protect your assets and your legacy? So you want to make sure that you get into a position that you're able to set up an estate plan as well, because that's going to be really important. Making sure that you work with somebody that has been in the business a long time, understands what they're doing, especially through these type of mortgage options and strategies, is really important. So make sure that you're looking up the person that you're working with. You can go and look up all of my reviews. I've been in business for almost 19 years. I'm a top producer, President's Club. Our team is super focused on making sure that we provide service and that we're helping our clients build and protect wealth, period. That's what we're doing. We're, of course, make sure that we deliver on our promises with just communication, making sure that we're taking care of you, that you understand what's going on up front all the way through the process, and making sure that you close on time, and making sure that you're given all the information to continue to build wealth. So I've created a lot of different courses, classes, education to help my clients create a financial plan so that they can work through building wealth, protecting their assets with homeownership, but even beyond that. So the next steps really is figuring out your budget. What is out of all these scenarios that we talked about today, which one do you think is going to be what you would want to pursue, or which ones do you want to look into? And then we can look at those options. You'll want to start by getting pre-approved. So reach out to me, let's schedule a consultation, have an initial mortgage strategy call. And then from there, we can start the process of getting you pre-approved and figure out what are your mortgage options so that you can start looking at homes and start your home shopping. Biggest thing is, again, budget. Figure out your budget, figure out what you can afford. If you don't have a budget set up, send me a message. I'm happy to send you over a course and the tools to be able to set up a budget and walk you through how to do that. So again, before you're looking at homes, you definitely want to make sure that we get you pre-approved, get all your documentation, and make sure that you're in a great position and that you can qualify, because there's so many things that you can see here that really can go wrong through the process. So working with the right team is going to be most important in dealing with this. Now, here's the do's and don'ts. If you are thinking that you're going to purchase or do some type of financing coming up in the future, don't open any accounts, don't close any accounts, don't co-sign for anyone. If you have changes in employment or income, make sure to reach out so that we can walk through and make sure that you're going into the right position that's going to be beneficial for you. Interest rates, all of that, we're going to go over understanding, what rate options you have, what mortgage options you are. That's part of our mortgage planning strategy, so that we can ensure that you're in a great position. And then we walk you through the entire process. So once you're in contract to purchase a home, we walk you through, you get updates, you know exactly what to expect, especially if you're going to be doing a contingent offer, meaning that you're going to sell and buy at the same time. Then we want to make sure that, you're comfortable with that it's going to work for you and that you're not going to be stressed. And so knowing that you're working with a team that's going to be on top of it and making sure that you have all the right information, that you know what to expect, that everything's set up, is super, super important. And that way you don't have to stress. If you're working with the right team, we do it all the time. It's not a problem. And you can just worry stress-free. We really live by our core value statements and our legacy, which is just to make sure that you are properly educated, have proactive communication, have high level of service, integrity, trust, and that you get what you're expecting and beyond that. So what's next? How do I get pre-approved? Reach out to me. Let me know when you have availability. Let's first just schedule a strategy call. Let's figure out, what are you trying to accomplish and what do we need to do to get there? Now, you may say, I'm not ready now. I'm thinking in a year. Great, call me. Let's get started now so that we can get beyond any of the concerns or issues that might come up through the process. Let's tackle those now. Let's get you in a position that you'll be able to, safely move forward when you are ready to move forward. You don't want to start right before you look at homes. You want to start ahead of time to make sure that we've addressed everything that needs to happen, because maybe we could be working on your credit too. Let's look at your credit and see, are there some things that we can do in the meantime to help get your credit scores up so that you're in the best position. My goal is to put you in the best position possible that's going to give you the best mortgage strategy so you can make the best decisions and build wealth.